really grateful to be partnering with Town and Country on this webinar. Anybody that's taken a class at the Kids First Center knows that our primary emphasis is the divorce and separation process, the impact on children. But money issues can't be really separated from any of our discussions. And I'm really thrilled that we're able to bring a much more laser focus on some of the financial pieces that that add to the already stressful time when people are choosing to separate or divorce. Again, this is having the expertise of the credit union and your perspective of working with the population of people that we typically work with. I think it's a very nice partnership, and very grateful to pull this together. People are not here to hear me talk. I just do want you to know that I am, in my prior life, an attorney. I can't give legal advice, but there may be some questions that we can talk about generally about legal things at the end. But with that, I think I'd really like to turn it over to Chelsea and Nicole to do their thing, and really looking forward to this afternoon's presentation.
Thanks. Thank you, Tim. And just so you know that following Nicole and Chelsea's presentation, we will have some time to ask them some questions. When you registered, you submitted a few questions about things that you were hoping to hear from the presentation. So we'll draw on some of the questions that you submitted at the end. Without further ado, we'll let Chelsea and Nicole take over.
All right, thank you, Linda and Tim. My name's Chelsea Torrey. I'm a mortgage loan officer with Town and Country. I've been with the credit union for about 3.5 years now. In my prior life, I worked with the USDA Rural Development. So I worked almost exclusively with households and families who maybe were experiencing these situations. One parent households were pretty common for me to work with in that capacity. I also have brought that with me to the credit union. So I am a loan packager for the Rural Development Loan Program. So I can still facilitate our members and our community with that loan process. And then there are also times when you might be looking at more conventional means, either through a new home purchase for your separating family, or for a refinance transaction and dividing the equity in real estate. So happy to be here tonight and grateful that all of you could join us, and looking forward to this presentation.
Hi, everyone. My name is Nicole Lemieux, and I am the branch manager of the Forest Avenue location in Portland for Town and Country. I have been with Town and Country for just about 11 years, primarily working in the branch setting, helping members and our community members navigate to get to meeting their financial goals. In my previous life, 11 years ago, I graduated from the University of Southern Maine with a social work degree. So I feel like I'm able to use my social work degree at work every day, being able to help and guide members of Town and Country and the community to get to those financial goals that they're trying to reach for. And I just wanted to also thank you very much for coming on tonight. It's great to be a part of this. So without further ado, a little bit about Town and Country. We have been helping people navigate financial hurdles and protect their future since 1953. We have 40,000 members. We currently serve Cumberland and York County. And right now we have 6 branch locations that are spread out in Portland, South Portland, Scarborough, and Saco.
And we're going to talk a little bit just about, the facts. Fact of the matter is that separation and divorce are very costly processes. The average cost of a divorce in Maine that involves attorneys is around $11,000. Cases involving children are the most expensive. Dealing with the parental rights and responsibilities component can be quite a bone of contention for a lot of people. Child support to protect the child from the economic impact of divorce and separation. I think that's something that's really important to keep in mind as you navigate the process, because the priority, especially when children are involved, really needs to be on them and maintaining their quality of life to the best of your ability. And then 2 households, they cost more than one. So you've got to rework, and we'll talk a little more throughout this presentation about looking at the budgeting side and how you make that transition. Some of the questions that we want to be able to answer for you, and we hear from the community that we work with pretty frequently, are: how do I protect my money and assets? How do I support my family and also pay the bills? How to live, and then how do I secure my financial future? So obviously these situations are dealing with the here and now, but you also have to be able to focus and plan for life as well, and what your goals and aspirations are.
So to go over the protecting your money and assets section, first, separation and divorce can reduce in income, added debt, and also can impact your credit score. Having to take bills and separate them out, that can also be a stressor on credit score. Being proactive and in control of your finances is really key. The earlier that you start the conversation about your finances and how to possibly separate things, your income being reduced, the better. So it's never too early to start that conversation. When you do start that conversation, whether it's with an institution, you want to try to make a list of all of your assets and debts that you currently have. That's really helpful when somebody comes and speaks, say, with me in my office about a possible start of a separation, or maybe they're already in the middle of it. It's extremely helpful to have a list of everything that you currently have for assets and also things that you're paying out. It just gives a bigger picture of what we're up against and what we need to sort of make, a list of, so that we know where to start. I want to make it clear that it's very okay to ask for help. Going to your institution is very important. We can help with a lot more than just your bank accounts. So it's definitely important to reach out to your financial institution. And then to know your whole financial picture, again, is very important as well. When we talk about, bank accounts, uncoupling your accounts, this could be checking, savings, investments, and retirement accounts. So you can reduce your liability by closing out joint accounts and then opening up accounts in your own name. When you go to your institution, you can ask them, how do I remove my, an ex or somebody that you might be separating from the account? It's much better for liability if you do that early on, and then start establishing your own checking and savings accounts as well.
And protecting your money and assets continued here, dividing and managing debt. One of the harder issues to tackle is who's going to be responsible for what when you leave the table. When it comes to dealing with joint debt, it's really, really important to have that conversation as early in the process as possible. We have some people who come to us very early on, before they've even shared with their spouse that they're contemplating this. Sometimes people are very proactive with it, and they really want to make sure that they can, financially be okay on an individual basis before they take that leap. Then you have other people who come to us after they've already gone through the courts, and then, you know, they've been told that they have to refinance this and that into their own name, and it can be a little tricky to navigate that process after the fact. So again, the earlier that you can start that conversation, the better. You have to consider things like joint credit cards. A lot of times people are listed as authorized users on credit cards when you have a joint person involved. So sometimes it's very easy to remove them. Other times you'll have to open a whole new card so that you don't have that joint obligation together anymore. Vehicle loans, RVs, personal loans, boats, you know, four-wheelers, anything of that nature. Those are things that, you know, with some assistance and some thorough communication, typically we can work out some ways to get those resolved. Sometimes it might result in either needing to sell something or, you know, transfer that in some other capacity. But and then also real estate loans. So, you know, that's where I come into things. Again, I work with people on dealing with, you know, refinance transactions if the loan is already in one person's name and they're going to retain that house, but they want to pay out a portion of the equity. They can work through either a refinance transaction or a home equity loan, both of which we do offer at Town and Country. So we have a lot of different tools and resources to tap into. Separating the debt, you know, either refinancing, buying out that separating partner, removing a user from different accounts. Again, it's all really based around working together to achieve the best possible results for everybody involved. It's really important to put the pencil to the paper, like Nicole had said previously. Having that whole financial picture right from the get-go is really, really important. Sometimes people do everything jointly together. Maybe there's one financial manager in the household that really takes care of just about everything. And so the other person might be completely in the dark on really what's out there. And depending on kind of what your position is in the separation, you know, you may or may not have all of that information readily available to you. So it's really important, you know, whether you're considering separation or not, to be aware of your finances on an individual and a joint basis. And very, very importantly, is maintaining your credit score. Separation and divorce have historically had a detrimental impact on people's credit profiles. Again, it's something that we see pretty often where possibly a separating spouse or partner that didn't follow through on their side of it. Your credit score is not the basis for everything. Is, you know, it's not the most important component of your credit, but it does guide you to know really what's going on behind the scenes. Monitoring your credit activity is probably the most important. Your score is not always going to swing drastically, you know, with different activities. But you, of course, want to make sure that there are no late payments that are being made, especially if any obligations do remain in your name after the separation is completed. And then calling creditors before you do fall behind to see if there's any way to work things through that won't adversely impact you or that partner. Just a quick story for everyone. You know, I had how important it is to make sure that you are fully aware of what's reporting in your name. I had people who had gotten a divorce. The separating partner was supposed to be removed from liability on the loan, and they never were. And they didn't know until almost 10 years down the road. They went to buy a new house with their new partner and found out that the property that they had previously owned with their spouse was heading into foreclosure. So it is absolutely crucial to make sure that you're monitoring that.
So when we talk about the next part of this presentation, which is living and paying the bills, We talk about the fact that, going through a separation or divorce changes a 2-income household into a 1. So this means that you're going to have to probably create a new budget for yourself. Just a couple tips on creating a new budget. One of the most important things is to be realistic. So sometimes people will overspend and oversave, and it's really important to kind of look at everything as a whole based on your income, and then just be really realistic about your new budget. Chelsea mentioned earlier that we do have a really good tool for that. It's free to anyone, and it's savvymoney.com. We have a slide later on that will show you that website, but it's really good because it'll help you create that budget for yourself, and you can adjust it accordingly, and it's not set in stone, which is another really important thing for everyone to think about when they're creating a new budget, is that it really, it needs to be able to be changed. It's going to need to change as your income and spending changes. So when going through separation and divorce, there's going to most likely be a change in income, which will equal out to a change in spending. Right now, especially, I'm sure lots of people are dealing with their children maybe being home more often right now due to the pandemic. And so now we have a lot of different expenses that are happening that might have not been the same prior. I know childcare, is costly, and I'm sure many people have their children in childcare more so now than before. I also know that just speaking with people in my office that, the grocery bill is now a little bit higher because we have our kids home more often and they eat a lot more food. So it's just making sure that we change that budget according to what's going on in our life at that time. A divorce or separation, looking at your budget means that we need to look at your income sources. So when creating a budget, it's really helpful to look at your net income. So what you actually bring home and you're able to use. It's best if you can try to not rely on any child support income if that's something that you do have. That's sort of like an added amount of income that's helpful for other things. Adjusting expenses according to your income is very important. Prioritizing your needs versus your wants. Something that I do a lot with members who, want to start building that budget is we'll print out a couple months of statements, and we'll highlight the things on there that, were sort of a want. And it's amazing how quickly those small purchases add up. I have a member who loves to drink coffee. Well, $3.50 a day adds up over time. So it's really important just to take a look at those things and see what are my needs and what are my wants. And that goes along with analyzing your spending habits. So just looking at what am I spending my money on and how maybe can I adjust that. And then, of course, I said before, and I can't say it enough, but monitoring your budget and then always adjusting it according to whatever is going on at that time is really important. A lot of people adjust their budgets, monthly or sometimes even weekly, because things do change and we have to be able to adjust our budgets accordingly.
Important factor as far as the budgeting and what's affordable, what's feasible for you to consider is if you own real estate, whether or not you can afford to keep the property. Sometimes one partner will stay in the house. Sometimes you'll sell the house, and other times people are doing kind of this new age way of nesting. So they'll, on the day that one partner has the children, they'll stay in the property, and then on the day the other one has the children, they'll stay in the property. So they kind of do this revolving door thing. Of course, that's not going to work for everybody, so you do have to evaluate what makes the most sense for your family and your particular position. Looking at the real estate market now, you really have to look at the reality of it. We're in a very elevated market right now. So the risk of being underwater on a property is pretty low at the moment. However, circumstances can change pretty drastically in a short period of time. The anticipation is that we're going to see between a 9 to 20% decline in market in the real estate environment over the next year or so. So it's really important to keep that in mind. Sometimes selling the home may be your best bet, especially if it was today. While it does uproot a lot of other aspects of your home and the kind of stability for your family, it is a really good market to take the equity and be able to divide that equally amongst you and kind of hit the refresh button. Maybe get into something that will be a little bit more affordable and manageable long term for you as individual households. And then you have to look at what can you realistically afford on one income. So looking at your debt ratios is paramount to really everything you do. You have to take that into consideration. Nicole mentioned looking at your net income. From a loan perspective, we're always looking at your gross income and what that looks like. And the typical rule of thumb is that you don't want your housing expenses to really exceed roughly 30% of your gross income. That number does have some flexibility to it and can go, up to 35%, sometimes 40% if you really have no other expenses. But then your total debt ratio, you really don't want to exceed about 45%. And that is going to be all of your monthly bills, your actual obligations like mortgage or rent, your vehicle, your student loans, credit card minimum monthly payments, things of that nature, divided by whatever your gross monthly income is. A lot of times I can look at someone's financial profile based on their gross income and tell them, you might qualify for a monthly mortgage payment of $2,000. Does that mean that you're going to be comfortable paying $2,000 a month for a mortgage? A lot of times, no. People have a preconceived number in their mind as to what is comfortable for them individually. And I would certainly urge anybody who is being kind of pushed outside of that comfort zone to really take a careful and close look at it and make sure that you're not putting yourself in a position that is not going to be sustainable long term. Looking at keeping the property and the division of equity in the home. One thing that happens pretty often, again, is some people will come to us early in the process and we can help them develop those numbers and where everything aligns. Sometimes people come to us really late in the process after that decision's already been made and they have a court paper that says, you have to refinance this within the next 90 days or 6 months or whatever time frame was agreed upon. Sometimes it will dictate that the equity is split based on the market value of the home. However, from a lending perspective, we're generally working with about 80% of the value of the property. So it does kind of put people in a little bit of a pickle sometimes where they've agreed to a much larger figure than is really realistic for us to work with. So again, have that conversation early on, review the finances with somebody who can guide you through that process. And it will be much more promising with the results once things are getting finalized.
And I think talking about debt ratio, this is a great slide that we use a lot when we talk about expenses versus income. And like Chelsea did say, when we're talking about a loan perspective, we do use your gross income. But when we're talking about a budgeting perspective, we want to talk more about your net income. So these are some really good percentage targets to look at. For example, when you're talking about creating a budget, your mortgage and housing expenses should be between like 30 and 40% of your net income. Transportation, your auto loans should be right between 10 and 15% of your budget and your income. And then, of course, we talk about other living expenses, which could be groceries, insurance, should be right between 35 and 45% of your net income. And then, of course, if there's any other loans or credit card minimum payments, that would be right around like 10%. And then savings and investments are also very important to consider when we're talking about budgeting. It is important to try to work that into your budget however you can. And I tell people all the time, every little bit of savings helps. So even if it's $10 a week after the entire year, that $10 adds up to a lot more than what we think. So it's important to not over budget or under budget these things. And this will give a good idea of how to keep your budget comfortable when we're talking about probably most likely changing some of our spending habits or our housing situations. This is a graph that we have broken down. It's just an estimate of what a spending plan might look like on 2 incomes versus and 1 income. So just for an example, if you look at the clothing costs per month on 2 incomes, we're talking about $100 maybe a month you're spending on something like that versus 1 income of $25 a month. And then when you look at food, just an estimate would be $600 a month on 2 incomes versus $400 a month on 1 income. And then, of course, when you look at extras, so those would be things that we would work into our budget so that we would make sure that we had, able to get our haircut or maybe go on a family vacation. And so that just gives you an estimate of what it's like if you have 2 incomes versus 1. Same with the housing. We're talking a lot about housing. And so 2 incomes, you might estimate your mortgage or rent would be right around $2,000 a month versus $1,200 on 1 income. And then it breaks it down at the bottom and it shows you what your net pay might look like on 2 incomes, around say $6,200 versus 1 income of $3,100. And it gives you the balance at the end of that month. So you can see 2 incomes, the balance might be right around $1,360 that you would have left versus $20 on 1 income. So very important to really start thinking about a budget so that we can make sure that everything is accounted for at the end of the month. Along with savings, we want to talk about 3 key savings. We do this a lot at the credit union, and I think it's really helpful to just go over. Short-term savings would be an account or something that you would put money into that would be used for maybe something like getting tires on your car before the winter or registering your car, something that's short term that you're probably going to need to spend money on, and it's much easier to save it along the way rather than have to come up with a large chunk of money, say to register your car. An emergency savings is important. There's a national study that shows 40% of people do not have an emergency savings to pay for a $400 emergency. So, that just means that if there was an emergency situation that was, say, $400 a month, most people don't have that. So I think that's important to think about. However much money you can put aside, whether it's $5 or $10 a week, it does add up very quickly. And then, of course, your retirement savings is also a very important one to think about. So, and I mean, a lot of your jobs probably offer something, so it's important to check that out as well with them.
And recovering from joint debt. Separations don't always go as planned. We deal with a lot of tensions in our relationships, even in the best of circumstances. Sometimes there can be other frustrations or external factors that prevent somebody from being able to follow through on the obligations that they have, whether it might be a job loss or, emergency situations like a vehicle breaking down or something like that. When it comes to the joint obligations that you have, again, monitoring those and making sure that they are paid so that they don't adversely impact you personally is really important. Sometimes you have to set aside your pride and you have to be okay with taking on that obligation. A divorce decree or a court order that somebody is responsible for a debt does not mean that you are no longer responsible for it. The creditors are still looking to you for payment. When it comes to your own personal financial future and what your goals are, if you want to buy a new car, you want to buy a new house down the road, or, have credit available to you in any capacity, sometimes you will have to pay debts that you don't feel are necessarily yours. And it can be a bone of contention for a lot of people. What you don't want is for that to negatively impact your familial relationships, especially, again, when there are children involved. You do not want that added tension of these obligations there. If you do end up having to pay something so that it doesn't negatively impact you, then you can turn around and go to court and say, this person didn't follow through on their responsibility. That's what the court order does for you. It does not remove you from responsibility for that debt. So it is really important, again, to just make sure that you continue to monitor that as long as that debt is reporting in your name. Converting revolving debt into installment debt, that's something that we look at quite often at the credit union. When people have credit card debt, it can negatively impact them much more so than an installment loan will. So sometimes if you have credit card balances, across 5 different credit cards that might be $10,000, that could be really plummeting your credit score. So what we would look at is doing a small personal loan that would allow you to consolidate all of those obligations into one fixed payment. If any of you have looked at a credit card bill recently, you'll see how it outlines, if you make the minimum monthly payment for the next 17 years, you'll have this paid off and you'll pay, at least $8,000 in interest. But if you convert that over to an installment debt, then you're going to be paying an amount towards that principal balance every month and an amount to interest. And that interest rate's going to be smaller typically. And so you're going to actually be on schedule to get rid of that debt entirely. And why care about debt to income ratios? Again, looking at housing and that 30% debt ratio mentioned earlier, and then your overall debt ratio around 45%. Again, both of those numbers can have some flexibility, but your debt to income ratio is really just as important as your credit profile. Sometimes people will come to me and they say, I have impeccable credit. I've got an 800 credit score. Well, you might have an 800 credit score, but on paper, what we can document as far as your income and your expenses, you might be at an 80% debt ratio. Sometimes that can happen if people don't have a housing expense at the time. And so that what they'll do is they'll, buy some toys, buy a new vehicle, buy a 4-wheeler, buy a motorcycle, whatever it might be. And then they want to go buy a house, and it can be very tricky to do so without possibly giving up one of those things that you really enjoy. So it is important to keep in mind and just review cognizantly as you navigate the process for sure. And some other really important aspects, especially associated with a separation, is looking at these other facets of life where you might need to make some updates. doesn't necessarily tie into the day-to-day finances, but it does have an impact on your financial future and what that looks like. Looking at wills, trusts, any power of attorney, most people may not want a power of attorney in place where their ex-spouse might have the opportunity to take out a loan in their name. So you want to make sure that you terminate those items or really hang on to those documents and maybe review those on a regular basis. Looking at your beneficiaries for retirement, insurance, life insurance, pensions, those are things that oftentimes we don't think to update. You know, if we get hired at a new job or something like that, you know, we get a stack of paperwork, we have to fill all these things out, and then we never think about it again. So it is important to check back and see, you know, if you've had either you know, had a recent separation or remarried or whatever it might be, that you connect with your HR and make sure those things are updated so that the right person, in the event of anything tragic happening, is getting those funds. Looking at real estate again, you might own a piece of land or a family camp or have a, you know, a partial interest in a piece of property. You just want to make sure that those things get conveyed appropriately when necessary. Sure that you have your name change and social security details updated. Not only do social security benefits get impacted by some of these things, but you also, when it comes time to file your taxes, if you have a name change, they're not going to acknowledge your name change unless you update that information with the Social Security Administration. Resetting your account passwords and any PIN numbers. You know, it's important, obviously, if you've had some standard ones, you know, that were openly used as a couple for years, that you reevaluate those and make sure that those are held securely, just to protect your own individual assets. And then looking at your direct deposits, it can be a process. You know, these things don't happen overnight. And Nicole talked a little bit about converting, you know, joint accounts over to individual accounts, and the direct deposit kind of goes hand in hand with that. And it might be a gradual thing. You know, for a while, you'll likely still have some joint obligations where you might still have to have some of this money run through a joint account. But if you are going to be setting things up on a more individualized basis, you'll want to set up a portion of your direct deposit to a new account in your name, where only you will have access to those funds.
So as we wrap up, some takeaways from today's being proactive. So we talked a lot about that, Chelsea and I both, in different aspects, but it's never too early to ask for help. Being proactive and, you know, reaching out to creditors and your institutions is very important. I talked about earlier separating accounts to reduce liability. That's something that you should be able to speak with your institution about. And, you know, to Chelsea's point, the direct deposit is also an important factor to that. So separating those accounts is something that you should be able to do with your institution. We talked about separating joint debt, loans, and credit cards. We also talked about the fact that, you know, while you're trying to separate those debts, don't forget to continuously trying to pay them as well. Because, you know, in some cases, even though there's a divorce decree in hand, it doesn't necessarily mean that you're not still liable for those payments. So in order to protect credit, it would be a good idea to also try to continue to pay those liabilities while trying to separate the joint debt. I talked a lot earlier about making a new budget to reflect possibly a new income, expenses, and lifestyle. Also, just wanted to reiterate that the budget is something that can be changed and should often be updated as well. Regularly monitoring your credit score and your credit report. We talked about Savvy Money, which is in the resource tab here in one of these slides coming up. That's a really good online site that we offer to people for free. It doesn't only build the budget that I talked about, but it also monitors your credit report. So it will send you email notifications if something has changed. You can jump on there anytime. It'll show you your up-to-date credit report, and that's a really good way to be able to monitor, what's going on your credit. And then, of course, don't ever hesitate to reach out for help. It's never too early. It's never too late. So just always make sure that, if you are in need of some advice or some help, don't hesitate to reach out.
And just a rundown of resources, we mentioned several times the Savvy Money website, www.savvymoney.com/TCFCU. That will allow you for free access to that credit monitoring services. And we, I think, most of us, especially as employees, are all signed up for this service, and we use it a lot individually ourselves. So, we see the benefits of that tool. It takes a little time to get familiar with it and navigate it, but it is a great resource. And monitoring your credit score is important, but again, looking at the contents of your report is even more so important. You want to know that there isn't anything adverse that's reporting there. Looking at the payment history, annualcreditreport.com is a great resource. It used to be that you could only pull from each of the 3 credit bureaus one time annually. However, thank you, COVID, they've come out with being able to do that on a weekly basis now. So after all of the fraud that went on with the unemployment and everything, they've opened that up so that you can actually access each of you 3 reports with the credit bureaus directly once a week at this time. So I would certainly encourage anyone to take advantage of that right now. The money management tools within your online banking platform through whichever financial institution that you might use. Town and Country has some financial management tools within our online banking portal. It was really great to be able to get that set up and have your finances really well organized. We talked a lot about the budgeting, and it does a lot of the work for you. It takes a little time to get everything set up initially, but then it will automatically categorize your purchases, your debits, your credits, all of those things, so that you know where your money's going. And it's really helpful especially when you want to look at making some changes and possibly shifting, possibly more to savings, and where you might be able to take that from. And then obviously, reach out to anyone, a live person who might be a good resource for you. Any personal financial planners, certified public accountant, an attorney, a local credit union or bank representative. Those are all really valuable assets to you in navigating what your financial future looks like. So certainly make sure that you are asking the right people. We at the credit union, there is a lot of financial expertise that we do have, but there is some that we don't have, and we are totally okay with referring you to someone who has a little more expertise with what you are specifically looking for advisement on. So. And I think we're switching over to Linda to do a couple of questions for us. And certainly thank you all again for participating in this presentation tonight. We hope it was helpful.
Thank you so much, Chelsea and Nicole. I think it was lots of very useful information, and thank you so much for sharing all those insights and suggestions. And if any of you that are participating do have some specific questions, or something you'd like to talk to either Chelsea or Nicole about, you can see their email addresses and phone numbers are up on the screen right now. So don't hesitate to reach out to them. And we do have a time for a couple of questions. As I said earlier, many of you had submitted some questions when you registered. So I have a few that I want to build on some of the things that you touched on, and to give Chelsea and Nicole a breather. Tim, I've got a question for you. They touched on and talked a lot about talking about your money and reviewing where you are early on. So going through the separation divorce process, what is the best time, if there is the best time, to decide how to divide your accounts, your debts, your assets? What's some good guidance about that to help people maneuver through this?
Well, that's an excellent question. I guess I want to preface the answer with just pointing out something that people may be wondering about. When at the Kids First Center, we talk about divorce and separation as when it involving children as being the same, which it is. There's no difference between a divorce case and a parental rights case when it comes to working out arrangements for caring for your child or your children. There is a difference in separation, a parental rights case and a divorce case when it comes to money. So in a divorce, the court has jurisdiction over the marital assets, what we call the marital estate. In a parental rights and responsibilities case, where it's just about children, although you may be living together, you may own a house together, have assets together, the court doesn't have jurisdiction within that proceeding to divide the assets. So what we're really talking about, all the principles that Chelsea and talked about apply to both. There is a big difference of how that gets enforced through a court. So, and it's really in a divorce proceeding. So going into your question, the best thing, and it's really reiterating what you've already indicated, is you really have to have a good understanding of what's in the marital pie. You can't cut the pie up until you know what kind of pie you've got. So one of the best things early on in one of these cases is to take an inventory. The court, if you're in court, will require a financial statement to be filed by both parties. So in theory, what you put on yours should be the same as what I put on mine. Sometimes there are some surprises. You really so the big part of the process is getting a good sense of what you have, and then working through a comprehensive plan of how to divide it up, and that and to the extent that can be done by agreement, with the assistance of attorneys, with the assistance of bankers and people like yourselves. Really can figure out how to put it together so so each party comes out hopefully with about 50%. Maine is what's called an equitable property state, which generally means the estates are divided equally, but not necessarily. So the actual division before that's done, it's really important to have an agreement. The days of going out and cleaning out a bank account, I'll use a technical legal term, judges get really grumpy when people do that. It's just not it's not looked upon favorably by a court when one party takes what we call self-help and secures assets for themselves. So the best thing, and you can start even before you even thinking about divorce or separation, is that inventory and really getting a good sense of what you have. And then which is sometimes the hard part, and then dividing it up is just a function of how do we even things out? How do we maximize each party's position with what we've got? So it's every case is a little different, but it's that understanding of what you have is critical to then dividing it up.
Mm-hmm. And I think too, the more that you can do your homework and have understanding of where you stand and start that conversation about how do we divide it up, the more agreement you have, the more money you're going to save in the long run, because going back to our beginning, divorce can be expensive. So, and legal fees kind of add to that. So the better we can work with our partner that we're separating from, the more money we will keep in our pockets in the long haul. A couple other questions that we have that came up. Chelsea, I think this is for you. Someone had asked, what should I keep in mind if I want to make a large purchase, like buying a house, before the divorce is finalized? Is that recommended? If they're going to do that, what do they need to think about?
It is really important that you have the appropriate permissions to know that. Just handling the real estate side of things when you are looking at the purchase or sale of property, especially if there has already been a motion for divorce, can require some permissions from the court, I believe, in different circumstances. So it's just important to know that and to make sure that you are not doing anything in a secretive manner. The last thing that you want to happen is to acquire property, personal property or real estate, and then find out later on that someone else has rights to a portion of it as marital property. So make sure that you do your homework on that and communicate with hopefully that partner or spouse, and also with an attorney if you have one.
Mm-hmm. And Nicole, I think we have time for one more question. I'm going to send this your way. Talking about or thinking back about the importance of monitoring your credit score. You guys talked a lot about Savvy Money as a great tool. What kinds of things can someone do going through the process or just kind of in general in life to maintain a strong credit score? What kinds of things does someone have control over to help keep their credit score strong as possible?
Yeah, it's first of all very important to monitor it. Keeping your eye on that credit score is really important. When we talk about credit, we talk about a lot of different factors and what makes up a credit score and makes up your credit report. 40% of your credit score and credit report is made up of payment history. So when we talked earlier on in the PowerPoint about, if you are going through a separation and divorce and getting ready to separate liabilities or loans or mortgages, it's very important to still make the minimum payment while you're going through that process, because 40% of your credit report and score is made up of payment history. Also, Chelsea touched on it a little bit earlier on, where we talk about moving revolving debt, which would be an example, credit card debt. So I think she used the example, if you had 5 different credit cards and they equaled $10,000, some of those credit cards could be getting to the point where they're almost maxed out or they're over half of whatever your limit is. And when that happens, your credit score naturally will decrease. So moving those sorts of debts, even though it's the same amount, into a installment loan, like a personal loan, or even using a property or a vehicle as collateral, will help increase your credit score. There is a lot of different factors that go into keeping your credit score healthy, and monitoring it is, in my opinion, very important. It'll help you get those, if anything's on there that isn't supposed to be or reporting incorrectly. It's important to do that quickly so that it doesn't negatively impact you over time. But the most important thing is to make those payments on time. One late payment on a credit report can significantly lower that score. And when you're talking about going through a refinance process of either, say, an auto loan, from going from a joint to a personal, you do want to try to get that credit score as high as you can so that you can sort of reduce that monthly payment and make it very affordable.
I just spoke about. We will be sending a video recording of this webinar to you in the next few days. So thanks again for joining us and have a great night.